Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. This is my take on the US equity market chart book. Nick, our senior analyst, is preparing these, tries to be as factual as possible, as unbiased as possible. And here I come with my biased opinion. I try to read in between the lines and give you some flavor that I have from my perspective. And with that, I'm not trying to discredit in any fashion the work Nick is doing, by the way. I'm trying to supplement it and keep the interpretation separate from the data analysis. And by all means, of course, Nick also interprets the data, but I am daring to go out on a limb, so to speak, and interpret much more into it. And so this first chart here, in some ways I love it, in some ways I hate it. The reason I love it is because this chart suggests that over the next 10 years, you might not get much of a return in the equity markets. Not that that's a great thing necessarily, but to put the expectations right for the next 10 years. And obviously, as the comment there suggests, that's printed, that doesn't mean it's going to be flat line. We may have significant bull and bear markets over the next 10 years. Now, that said, this chart is pretty much an autocorrelation of equity indices on their own, so to speak. But it has some fancy talk about the Z1 report, and by all means, please look it up. But in brief, what this is when somebody sells a stock, or when somebody moves from stocks to bonds, well, on aggregate, the number of stocks, number of bonds, but just by itself don't change. But what may change, because for every buyer there needs to be a seller, but what may change is the relative valuation. And so what this chart shows that when historically stocks have been highly valued versus bonds, then over the next decades, the returns have been more modest. And so, not too surprisingly, if you go, for example, if you go here to 2000, and I'm trying to figure out here how to read this chart here because I haven't looked at it in a while. But the equity allocation here at 2008 over the next 10 years, the returns then ended up, this is at the end of 2008, so in early 2009, exactly. That was the end of the bear market. So the returns subsequently were very high. And so now that we've had this extensive bull market, the subsequent 10 years might be very low. And that doesn't mean you should jump out of the markets today or tomorrow. But to me, and several months ago, I wrote a paper on this, a little analysis on that, it is okay to be more cautious about the markets, even if other indicators go positive. And you put that into context of your overall allocation. One of the reasons we talk about the business cycle is because during bull markets, during economic expansions, markets tend to perform better than bear markets. And there's a notable exception, I keep mentioning that, is the 87 crash. But the business cycle backdrop is good. The earnings backdrop is good, and as you notice, in my interpretation of these, I don't spend an equal number of time on each one of those. Several people have pointed out that purchasing manager indices, if you look at them globally, several of them have come down. Notably, if you look at the German line here, has come down quite a bit. Now, that said, they're all above 50, so they're all signaling expansion. And so, again, it depends on the type of investor one is. As long as they're over 50, these charts suggest, don't worry, don't panic. And even if they're below 50, you don't necessarily need to panic. But it is part of the bigger picture. There is some cautionary signs out there. My own take is, by the way, monitoring those economies around the globe. The German economy is doing just fine. Indeed, it's bursting at the seams, and it does require higher rates. They need to have higher rates there, in my view, which, of course, might then the PMI to go slower. Financial conditions, very important in my view. There are different financial conditions indicators. We show the Chicago one here, which I happen to think is one of the better ones. The reason that's relevant is that when financial conditions deteriorate, and that's a fancy word for saying is that when banks are not willing to lend anymore, when it's more difficult to have access to credit, well, that's a sign to the Fed to ease up and make more money available if it wants the economy to accelerate. Whereas and that's also what I'm saying is, the Fed is not going to stop hiking rates just because the S&P 500 takes a nosedive. And the reason is that as long as the banks keep lending, they'll continue to be just fine. So if you look at early 2016, for example, you saw financial conditions dip down. That's a warning sign to the Fed that if you have here's the S&P going down and financial conditions going down, right? So financial conditions go down and the S&P going down, then suddenly the Fed says, ooh, are there implications? And of course, this is in the context of just getting out of QE, tapering starting. How the hell is the market going to react to all this? They don't know because it's never been done before. Now it's all different. Markets have been rising, and financial conditions are just chirpy. Everything is good. And so that means don't think the Fed is going to pause hiking rates just because the S&P comes down, if it does come down. You need more than that. It's the financial conditions that are the guideposts. This notion that the Fed does everything is a hostage of the markets, well, that's yesteryear, right? That is back here in 2008, where, yes, the Fed was a hostage of the market. We're in a very different environment today, and the Fed is not hostage of the S&P market. It's always going to be hostage of the credit markets of sorts, meaning access to credit and so forth, but not necessarily of the S&P. And so the S&P can decouple here from Fed policy. And that means unless, the whole point, by the way, of tightening, of raising rates is to tighten financial conditions. The reason that doesn't happen in lockstep is because in an advanced stage of an economic expansion, in my view, banks want to participate, right? They don't want to be left behind. Everybody else is providing loans. They want to provide loans too. And that's precisely the reason why the Fed keeps hiking. And so keep that in mind. And that's also why the Fed tends to overdo it then, right? Because especially if you have inflationary pressures come through, and we have done in some other chart books, they have to continue tightening, because otherwise the economy's overheat, inflation is going to go way above, and so forth. And it's all well with this symmetric Fed funds target, but that is a concern to the Fed. If things go too hunky-dory, if inflationary pressures persist, that means they'll continue hiking until financial conditions indeed deteriorate, and that means, in my view anyway, this market is going to be coming to an end as any other market does, or many other markets do, which means it's going to come to an end because the Fed tightens too much. This chart here is a in-house version of a market breadth chart. I'm not going to go into that too much right now. A market is reasonably bullish, nothing too extreme here. Margin debt is high. There are different ways of looking at margin debt. I'm not going to look at this too much. Let me spend a moment here on this chart here. You've all seen variants of this chart. I'm pretty sure you can read here the details in the bottom. But the short of it is, and this is to prepare you for the next chart in some way, but this is the classic investment theory that you are interested in a portfolio that has a low risk and a low correlation, the different ones. And so the lower volatility, lower correlation you have, the happier you are. And of course, if you have a low risk portfolio that has high returns, and you might have higher volatility as well. But the goal is the more correlated, the uncorrelated assets are, the more diversified you are. And that's here in preparation of this chart. Forget it for a moment what specifically it shows. Let me just show you that it shows two things. It shows a measure of correlation, it shows a measure of volatility. And the argument here is when volatility is low and correlation are low, that's actually a contrarian indicator. That means everything is great, you make great returns, potentially anyway, and but that can reverse. And you've seen here, if you look at the extreme case in 2008, you have the volatility is surging, and then also the correlation across asset classes increase. So let's talk briefly about this correlation chart. The short of it is when correlations are higher, you're less diversified, but they might break down again. What this is we're taking the 10 subsectors or 10 different sectors. It's not the subsectors, it's 10 different sectors of the S&P 500, and look at the correlation versus the S&P 500. We look at the correlation of each one of these, and then we take the average correlation of each one of them. So if on average, this particular indices are highly correlated to the S&P 500, then we're talking about a high correlation. And when several of the indices have a low correlation of the S&P 500, then that number is lower. If that's all too complicated, take some time to read this text down here that explains it in more detail. But the short of it is that this is, to me, a sign that we are not in a stressed environment. You probably knew that before you looked at the chart. Economic uncertainty is another way of looking at the markets. Let's not look at that too much. Earlier this year, the VIX index was in the news. This is kind of a measure of how well that short vol trade that was in the news works. And when this line is in the positive, that trade works. When it's in the negative, then it doesn't work. You get these blowout effects. Just leave it at that for now. It's a measure of how stressed the market is. Relevant here, I'm not telling you much that you probably don't know. The markets, everybody tells you, oh, on average, the S&P goes up X% a year. Well, it doesn't. The average might, but every year is kind of different. You have outliers on the top, you have outliers on the bottom, and if you can't stomach the outliers, then you might want to take precautions to prepare for it, right? Here's a scorecard. Feel free to pause here to study this in more detail. And this is just, again, just a little guideline here. And this doesn't mean the markets will necessarily go up or down, but if one looks at the markets from these measures that are based on historically how the market has acted, and again, the market going forward might act differently. I keep mentioning the 87 crash here, where you had good economic cycle and still you had a crash. It is always possible, right? And keep in mind also the backdrop with markets having gone up so much. I allege in a recent conversation with somebody just confirmed that yet again, people are reluctant to rebalance because they would have to pay capital gains and whatnot. And also, by the way, they have missed out, and they would miss out on any potential future rally. And so if and when a bear market does come, that's why these things tend to not kind of be over in a few minutes, because over time when people say, oh my God, why I'm in this market, it takes a long time for that attitude to kick in, just as it took a very long time for the attitude that everybody has to be invested in the stock market has kicked in. So these are Nick's conclusions. They're not necessarily mine. And let me just give you my take here very, very briefly. Financial conditions, yes, they are supportive. My own take is that the economic cycle, because of the tax stimulus, has done quite nicely, has done quite well. My main concern right now is overheating of the economy. And that's why I tend to focus more on what can I do here for the time being. I take positions on interest rates rising more than expected. Can't do that with the standard instruments in the markets. And then we're looking very closely when this market might be tipping over, so that then we can switch and take positions on rates lower than expected. Look on our website on the insights. I recently published an insight on what I think on rates. The reason I mentioned that in the context of the S&P is that I happen to think it's easier to predict the economic cycle than the stock market. And so just keep that in mind for diversification purposes, whether one wants to take a position on that. Anyways, hope you enjoyed. Read the disclosure here and give us feedback how you like these things. As you are aware, we are providing a bunch of different charts these days. Hope you enjoy them, and until next time.